Hello, folks. Welcome to Pro Trader Strategies. It's Thursday, August the 5th. We're an educational company, and if you want that edge, it starts right here with this education. So please smash that like button, you guys. The like button helps us out. If you want to comment throughout this video, throw it over there. I'll be happy to talk about whatever you're looking at. And what was I going to say? Got the notifications over there. There's a little bell. Make sure you hit that so that you guys get notified when I'm coming on live. It could be at any given time, especially throughout earnings season. I'm going to be popping on when and whenever. All right. So make sure you check that out. In this video, we're going to talk about the economic data, see how that impacts the overall market. And finally, we're going to be talking about option strategies or trades that I find based on what we're looking at here in the overall market. So let's get on with the economic data across the pond. The only thing we really got was out of Germany, the factory orders, knocking it out of the park, folks, coming in 2% better than what was expected at 4.1%. It was expected to be 2.1%. And a bonus, they revised last month's number up by 0.5%. So the German factory orders really looking good there. We got Great Britain's construction PMI, that was a little bit of a lagger. It's still above 50, which is showing expansion, coming in at 58.7, but a miss on the headline number, which was 64.5. And remember, last month we got 66.3, so really coming off of those high areas there. And then we got the Great Britain monetary policy statement. Basically, they left interest rates unchanged. Really not a whole lot to see there. One thing we did here in the United States was have Waller, who was an FOMC member, talking about cryptocurrency and this whole Chinese cryptocurrency. Now, if we don't believe the Chinese data on economic data or even really some of their earnings, well, it's kind of a little bit iffy on if I really want to invest in one of their coins, folks. I mean, it seems a little crazy to me, but I don't know. And natural gas storages here in the United States, 13 billion cubic feet, in line with expectations there of pretty much 16 billion cubic feet. So not really a miss there. Let's look at the overall markets here. We've got crude oil moving a little bit higher today by about $2. Now, we're seeing a little bit of a silver lining here with the economic data across the pond. Those manufacturing numbers kind of, we've been seeing some okay ones here in the United States, but good to see across the pond. We're starting to see some of this manufacturing data come in and better than expected. That will give a little bit of buoyancy to crude oil here, folks, because remember, I talked about this time and time again. The demand for crude oil isn't always you and I just driving around. It is really going into the manufacturing process, because when they break this crude oil down, it does make gasoline and airline fuel, right? Which airline fuel isn't probably being in high demand right now, but polypropylene, PVC, all of those things, the plastics come out of some of the byproducts as well, and that goes into the manufacturing process. That is going to be the big demand driver. So when you hear about people driving around or car sales, that's going to add a little bit of demand to that. But really what we want to look at is the manufacturing sector, because they are going to be driving this price higher if we start seeing that ramping up. Now, you heard me talking about I wanted to see that 59 trade happen here, as we would like to see oil prices come off for the consumer, especially coming out of something like this pandemic when we're starting to open up again. Is that we don't want that extra $10 a week going into a gas tank. I'd rather see you folks spending that $10, and I'm sure you would too, on a Starbucks or going out there and buying something that you wouldn't normally buy after not having to put that in your gas tank. That creates velocity of money is really where I'm getting at, and that is really what drives overall economies, is that velocity of money. You and I spending at smaller businesses, that smaller business spends about 80% of that within the community. And then that's how that money starts really ramping up and helping the communities. It doesn't help when it's all going into your gas tank and you're just burning it out. All right, gold futures, a little bit weak today, as Bitcoin is as well. Now, a lot of this Bitcoin weakness, we're seeing some strength here after Waller was really kind of talking down on some of these government cryptocurrencies. He's not really bashing on any other cryptocurrencies whatsoever. The ones that have kind of some asset backed, what he's really concerned about is somebody saying, hey, let's just hold on to a global cryptocurrency that China is in charge of. That does not seem like something that would benefit the overall global economy. All right, bonds. Starting to see a little bit of weakness, but we've talked about this. Interest rates aren't going to go higher before the end of the year. They're going to continue the asset purchases. We just saw at the last meeting, it's another $1 trillion almost in asset purchases, which is going to add buoyancy to the bonds. VIX coming off a little bit. NASDAQ all-time highs here as everybody is flying towards the tech sector. This Delta variant really getting a lot of headline news here and worry about the reopen trade there. That is going to benefit the tech sector here. And as we will see, they are the leader of the charge here in the equities to the upside. Dow Jones Industrial Average trying to claw back a little bit better than a half of yesterday's losses. It was just pretty much a free fall yesterday. But when we look at this, if I break this down into a day chart, we're going to see that we really haven't gone anywhere for the last several days. And even if I broke this down, if I can, I'm not going to be able to do the overnight on this one. I don't think it's set up for it to just add overnight on it. Add overnight is on futures. Just show open interest. Sorry. Shooting from the hip here. Show overnight. Why? Oh, highlight extended hours trading. Let's try that. There we go. So you can see pretty much even in the overnight to today, we have traded completely sideways across the board in the Dow Jones. And we'll see it again here in the E-mini S&Ps as the chart's a little bit better there. But again, just a sideways trade. And you guys have heard me talk about this a while back. I haven't talked about this so much recently. But when we see these equity markets or any market for that matter, it doesn't necessarily have to be equity. It can be futures, ETFs, or any of those. But what we see when we get in these little tight ranges that we're kind of following through with right now is that it's kind of like, if you remember the old balsa wood, and I'm dating myself here, but the balsa wood type of airplanes where you kind of put them together, maybe you get them at the 5 and under or something like that, but then there's a little propeller that's attached to a rubber band, and if you just spin the propeller twice, that rubber band doesn't wind up very much, and so this propeller just kind of goes slow. But the more and more and more you wind that rubber band, the tighter and tighter it gets, right? And then when you release, all that energy pops. Well, I kind of relate it to the same here in equities, is when you get these tight little bands like this coming across, it's like that rubber band getting tighter and tighter and tighter. And then when that energy is released, we get more of a dramatic drop or pop, okay? So that would be an opportunity for an option strategy where you are buying maybe a straddle, strangle, iron condor or something that going from the long aspect, because we can see we've got low implied volatility on something like this. So maybe something with the SPX or the SPY would be something where we could add something to just make for a pop and a drop. Because at this point, I'm leaning towards the risk is to the downside, folks, across the board here in equities. Although we are trudging higher, I think that there's still an opportunity for a downside move here. So I'm always looking for a little protection here, especially with the VIX coming off. That would be the time to do that. And the whole casino sector, I feel like, folks, that I'm getting a little bit crazy on that casino sector, because I think what they're doing there is fantastic. Yeah, the COVID and the pandemic really hurt these folks, but you know what? They've done so well for so long in the casinos that they didn't streamline that process so much. And they found during COVID that, hey, there's a lot of things that we could do better here. And they streamlined that process during COVID. So I talked about this yesterday with the casinos coming out. As a matter of fact, with Caesars, talking about how during the pandemic, it forced them to streamline and get rid of some of the fat that they had. Well, throughout the pandemic and coming out of this pandemic, even at 50% occupancy on these casinos, these guys are seeing the best years ever, because they've increased their margins by about 40% by cutting out a lot of this fat. So with that massive margin multiple there, you know, $1 billion in EBITDA for somebody like Caesars, with half of the volume is pretty amazing, folks. So with that said, I did add a little bit to my casino stocks. You guys remember I just blew out of Las Vegas Sands just a couple of days ago. Well, I decided to get back involved with this. Well, the other one I had on some long calls. I got the directionality absolutely wrong on those long calls in here. As a matter of fact, I think I did it in and around here, but the directionality wrong. Yeah, I got a little bit of volatility increasing, which helped offset some of that directional move, but not enough, folks. And now that I've got this high volatility, I don't want to be buying options like I did before. I want to be selling options. So I decided to go in to the puts and add a trade here for a bullish move. Now, when we're selling puts, that is the flip of the buying, right? You think normally where you're buying puts, that's a bearish move. But when I sell those puts, that means I'm willing to buy at that level. So, a cash secured put, you could think of it. I would be willing to buy Las Vegas Sands at or around that 35 level there. So I went into the September. It's right around 45 days to expiration. So I get that theta starting to really ramp up right now. I've got the high implied volatility, which I would expect to come out, especially with a rally. We usually see that. We can even see that happening today with the equities versus the VIX, right? We're seeing the equities move higher and the VIX comes out. Generally, we see that happen as the market moves higher, some volatility coming out of these. So that's what I would expect for this trade as well. And then, so I went into the September, like I said, to take advantage of some of that theta decay ramping up here. It's about 45 days to expiration. I'll talk about more of these details in these webinars that I'm doing on today after the close, Thursdays at around 15 minutes after the close. So, all right, so there you go, of the equity market. So the September sold to 35, puts in there for 68 cents. I'll be looking to cover those back for about 10 cents to a nickel on a bullish move. If you are newer to options trading, especially with a trade like this, I would be looking at doing this where we are limiting our risk, doing a short put spread, or I would be looking at this for getting out at about 50% of max profit. 68 cents is my collection. That's my max profit, folks. I never ride those out into the sunset. So if you got out for like 30, 35 cents, that would be about 50% of max profit. If you're getting into options trading and you're newer to it, that's what I would suggest you to do. If you have a higher risk tolerance and you've been trading options for a little while, I look for that 16 delta and look to trade that, get out for a nickel a dime. But 50% of max profit is probably what I would suggest for anybody that's a newer trader, especially on a naked short put or a cash secured put for that matter. All right. And when, let's take a look at when. I've been directionally wrong on this as well. You guys have been following along on this trade. I am long win from quite a while back. Same thing, talking about this reopen trade, thinking that win and the casinos are going to do well. Well, it hasn't quite worked out so well for this trade. And I had on this September, I got long the 135 calls in there and paid $8.35. I still have those on because they're almost worthless, folks, and there's no reason to take it off for maybe $1 or $1.50 when I've ridden it out this long through earnings that come out with better than expected earnings, talking about their margins as well, doing well through this pandemic and the reopening trade. So that said, I have again that high implied volatility here with the markets. I expect it to come out because we already have that binary event. Once the binary event comes out, we know just about everything, right? But today it seems like this volatility is coming out a little slower than expected. So I went into the September again because I want to take advantage of that theta decay, right? I had on the calls in the September from way back since basically 2 months ago and have kind of ridden this thing down, expecting at any given time that these casino stocks, everybody's going to wake up and say, hey, Vegas is doing all right. But I guess I'm well ahead of that curve. So with those September, I had bought those 135 calls. They're almost worthless. I'm going to probably let those expire unless we get a nice rally and I can make up for that. But With the high implied volatility, I'm still bullish the casinos, despite the fact that everybody else is hating on them, and went into those same September because now I'm at that theta decay area where we get the ramp up in theta decay, high volatility. I expect that to come out. I can get all of those things working in my favor here, folks. So that said, I went into the September, sold the 95 puts in there for $4.75. Now, the reason why I did that, not only I'm still bullish, but now that I have the opportunity to sell or collect a credit for these puts, I've kind of created more of a risk reversal, bullish risk reversal now, because I'm long call short put. So I will be able to take advantage of the upside move a little bit more, right? Because if I sell puts, that is positive deltas, and I'm long those calls. So those are positive deltas as well. If all of this can happen, I'm lowering my overall cost basis on those original calls I bought as well. So trying to make up for some of that loss there, but adding to a bullish position that I'm still bullish. A lot of times people would look at this and say, hey, Wolfman, you're throwing good money at bad money, meaning you have a bad trade on or a trade that's not working, and now you're throwing more money at it for a to make up for that loss. Well, I'm not necessarily looking at it, or I don't necessarily look at trades that way. If I were going out and buying more calls, I would say that that is more along the lines of throwing good money at bad money, because I am buying into this trade more. This is an opposite trade in a sense. Yes, it's still a bullish directional assumption, but what I'm trying to do is just take advantage of different levers and pulleys in the market around an underlying or a sector I think is going to do very well. So I'm not looking at this as throwing good money and bad money, because when I'm selling options, we know the probabilities of success are much better than the probabilities of success with buying options. So high probability trade I'm putting on in and around that underlying that hasn't really necessarily worked out. So Las Vegas stands to the upside. I'm also going to be talking about American Express and a couple of other ones. XLU, we're going to be using that as an example for the iron butterfly today. So if you guys want to learn how to do the iron butterfly, iron condor we did last week, iron condor, still one of my favorite option strategies. It's a very low risk strategy. This one has a little bit higher risk, but with that, we are going to get much better reward on that trade as well. And I'm going to show you how to set that up. We'll go through the rules as to how much credit you should get for this thing and when, where, and why you should implement it. But the most important thing is how, right? That's what we need to know. We need to know when we're putting on a strategy that we have the highest probabilities of success. And that's what I'm going to show you guys in these webinars. That's it. Folks, I've rounded it off. Thank you guys all for joining, and appreciate all the time, effort. Please, again, make sure you hit that like button. That does help us out. Subscribe over there, and if you get that bell, that'll give you a notification when I come in here unannounced. And the reason why I want you to do that is because during earnings season, I might pop in when I'm talking about a trade that I'm thinking about putting on, or I'm putting on right then. All right, so check that out with the bell, and that's it. Other than, if you can't take that, take it easy. You guys got lucky. I just skimmed the edge that time. All right, bye for now.